The client's name is not on any public list. His net worth is not in any magazine. The number your onboarding file carries is $340 million in liquid assets, and that is only what he has chosen to show you. You are 24 years old. Your title is Client Associate. Your job today is to prepare the quarterly portfolio review for a man you have never met and will not meet for another 2 years. You work at the private banking division of an institution founded in 1872. The carpet in the lobby is thick enough to muffle sound. Everything here communicates the same thing without saying it. Permanence. You came from a target university with a finance degree and an internship that nobody outside this building would find impressive. Inside, it was enough. The final interview round was lunch. You were being assessed on whether you knew which fork to use. You did. That is why you are here. Your first 18 months are invisible work. You prepare performance attribution reports. You coordinate with the custody team on asset transfers. You sit in on client calls and take notes your relationship manager will never read. The clients at this level do not think about their money the way ordinary people do. They think about it the way an engineer thinks about infrastructure. It is load-bearing. It must be maintained. It must not fail. Your job is to be part of the maintenance crew, not yet trusted with the relationship itself. Trusted with the accuracy of the document that supports it. That is the distinction. You learn the internal credit rating system. You learn which asset classes the bank prefers to pitch and why those preferences connect to the bank's own balance sheet positioning. You learn that the advice and the product are never fully separable. You file that understanding and do not speak about it. Year 2. Junior Relationship Manager. You have been assigned 4 clients. Combined assets under management, $180 million. These are not the flagship clients. They are the clients nobody senior wants to spend time on. They are also the clients where you will make every mistake you are going to make, in a room where the consequences are contained. Your first solo client meeting is a 40-minute review with a retired industrialist from the German Midwest. He is 71 years old. He is precise, formal, and completely unbothered by your age. He asks you one question your model does not answer. You tell him you will follow up by end of week. He nods once. You follow up in 48 hours. He notices. That is the beginning of the relationship. You learn that private banking is not about financial sophistication. Every client at this level has access to financial sophistication from a dozen sources. It is about consistency, about being the person who shows up with the right answer slightly before it was needed. That is the product, not the fund, not the structured note, the reliability behind it. Year 4. You are a relationship manager. Your book has grown to 11 clients and $620 million in assets. 2 of your original 4 clients followed you when you were promoted. That is the signal that matters. You are now invited to the morning briefings where the investment committee lays out the quarter's positioning. You are not yet shaping those positions. You are translating them into language that an 80-year-old widow in Zurich or a second-generation entrepreneur in Singapore can hear without anxiety. That translation is a skill. It requires you to hold 2 versions of every idea simultaneously, the technical version and the human version. You never confuse which one belongs in which room. One of your clients asks you to manage a liquidity event. His family is selling a manufacturing business. Proceeds will be approximately $90 million. You are the first call he makes after signing the agreement. Not his lawyer, not his accountant, you. That is the moment you understand what the relationship actually is. It is not about the portfolio. It is about being the person someone calls when the number changes and they do not yet know what to do with it. Year 7. Senior Relationship Manager. Your book is $1.4 billion. You have 16 clients. 3 of them you would describe with precision as complex. One family has assets distributed across 4 jurisdictions, 2 trusts, and a foundation structured in Liechtenstein. The conversation about that foundation requires you to coordinate between a tax attorney in Geneva, a fiduciary in Vaduz, and an estate planner in London. You are the center of that coordination, not the most technically qualified person in the chain, the most trusted one. That is a different qualification entirely. You begin to see the ethical architecture of this work more clearly. A client asks you to move assets in a sequence that is legal, documented, and structured in a way that makes the movement difficult to trace across jurisdictions. Compliance reviews it and clears it. You execute the instruction. You do not ask what the movement is for. You understand that not asking is part of the service. You file this understanding alongside the earlier one. The file is growing. Year 10, Team Head. You manage 6 relationship managers. Their combined book is $4.2 billion. Your own retained relationships account for $900 million of that. You no longer spend most of your time on portfolio mechanics. You spend it on people, on the relationship managers below you making the mistakes you made at year 2, on the clients above who require attention that cannot be delegated, on the internal politics of a division where your team's revenue is visible on a dashboard that 3 levels of management review every Monday. You lose a client. $240 million moves to a competitor. The reason is not performance. The reason is that the competitor's senior banker played golf with the client's son-in-law for 2 years before making an approach. You absorb this. You join a club you had not previously considered joining. You do not lose another client that year. Year 13. Market Head, Northern Europe. You are responsible for the division's revenue across 6 countries. You do not manage portfolios. You manage the people who manage the people who manage the portfolios. The distance from the actual money is 3 layers deep. What you manage is structure, hiring, retention, incentive design, the allocation of senior banker time across the client base. You fly to Stockholm, Copenhagen, Amsterdam, and Zurich in a sequence that repeats every 5 weeks. In each city, there is a dinner. In each dinner, there is a conversation that determines whether a relationship deepens or stalls. The conversation is never directly about money. It is about family, succession, the next generation, the philanthropic vehicle being considered, the estate question deferred for a decade. The money is underneath all of it. You know how to find it without reaching for it. That restraint is the most valuable thing you carry. Year 17. Deputy Head of Private Banking, Europe. Your name is known in rooms you do not enter. Your division manages $38 billion. The clients at the top of your book are not people you would describe as wealthy. Wealth is a category that dissolved somewhere around the $500 million threshold. What they are is permanent. Families that have been capital owners for 3 and 4 generations. Institutions disguised as individuals. The relationship with those families is not a banking relationship. It is custodial. You are not managing their money. You are holding it. The distinction is everything, and it is never discussed. You sit on the bank's risk committee and its investment policy committee. The decisions made in those rooms flow downward through every relationship manager on your floor and settle in the portfolios of people across 6 countries who trust the institution with assets that represent everything they have built. You feel the weight of that. You are supposed to. The ones who stop feeling it are the ones who eventually cost the institution something it cannot recover. You know this because you watched it happen at year 11 with a colleague who had been at the bank longer than you. When he stopped carrying the weight, the client noticed before anyone else did. That is always how it happens. You are finalizing a succession plan for a family whose patriarch is 84 years old. The estate spans 9 jurisdictions and 4 generations of beneficiaries. The document is 60 pages long. It represents accumulated trust built before you join the bank. You will likely never meet the 4th generation. They will work with someone currently sitting at a desk below you, preparing a quarterly report for a client they have never met. The carpet is thick enough to muffle sound. The institution looks exactly as it did when you arrived. Subscribe to Adrian Finance for more stories about how money actually moves.